Hi, I'm Siddharth Dash, or Sid Dash from Chartis Research, and today I'm joined by a distinguished panel of five to discuss the transformation in the credit lifecycle. To start with, I will invite our guests to introduce themselves. Jaya.
Hi, I'm Jaya, CEO of BCT Digital. BCT Digital is a risk and compliance company that operates through the globe, and we focus on banking and financial institutions, energy and utilities, and the sustainability space, especially following the risk and compliance cycle.
Thank you. Carl?
Hi, thank you for the invite, Sid, to join this group. Thank you very much. I'm Carl Sees. I am Head of Product Strategy for CubeLogic, and CubeLogic is an enterprise credit, market and compliance risk software, and we've got a big specialism in the energy and commodity space.
Thank you. Stas?
I'm Stas Melnikov. I'm Head of Risk Solutions Portfolio at SAS Institute. SAS Institute is a software vendor that specializes in AI and predictive analytics, so data visualization, business intelligence, as well as industry-specific solutions.
Feroz?
I'm Feroz Noorani. I'm a Chief Risk Officer of an international bank in the Middle East. My domain is enterprise risk, but we also look at a lot of other new emerging risk. And I have business background as well, so I can gel, how the business needs to go forward and what risk controls we need to put in place.
Tony?
Yeah, hi everyone. My name is Tony Finianos. I'm Chief Risk Officer with Afghanistan International Bank. Since 2 years now, I have long experience in risk management in the Middle East in emerging economies, Lebanon, Syria, Saudi Arabia. I'm happy to be here with you today.
Great. Thank you all. I think, as you can see, this is a distinguished panel with diverse experience and skills, and we will immediately start off. So what do you think is the central challenges from a credit operations perspective, particularly the migration, given the migration of credit to non-banks and other non-banking financial institutions, if you will? What are their major challenges, if you think?
So, as you have rightly mentioned, that we have had this, new emerging trend in the market that non-banking financial inclusion is happening, basically from the neobanks and the fintech. These people are actually directly competing with the banks when it comes to retail financing and some of the SME kind of business. And we in the organized sector, of course, want them to be in that space for the main reason being to have further financial inclusion. But they started at a time when the credit was easy in terms of, the liquidity, just before the interest rate cycle of high interest rates started. They had liquidity easily available, cheap funding, and technology from fintechs were all emerging. But today, when we step back in the current environment, the challenges are totally different, basically. We are looking at the underwriting that neobanks and fintechs have done in the retail space, especially, is for the people who were not in the banking spectrum before. They are new borrowers or a new generation of borrowers who were not eligible from the traditional banks came in. So the credit underwriting standards were totally different. To have this successful, we really need good technology and good analytics. So I think when we expand on that, we would know what are the challenges that these institutions are going to face in an environment today when liquidity is not easy and the cost of funds is very high.
How do you see information issues in this space, Carl?
Yeah, it's an interesting space because these types of firms have not had the benefit of a core banking system. For better or worse, the core banking system would give you the sort of the foundations. So if you look at, for example, in the loan underwriting space, there's a lot of manual processes, loan underwriting, in good times, as Feroz has said. And that being manual is slow. one would argue that gives, there is a lot of due diligence in that process, but you wind that forward, so you've now got a large portfolio, the times are not as good, and those processes are very manual. So you see problems where the early warning indicators are hard to pick up on and hard to react. Then also the reporting of what's in the portfolio, ostensibly there's not an issue with that, because they would tend to rely on traditional sort of fund management platforms to record the details of the portfolio, the loans, and sort of the basic information is there. But then a lot of these non-banks rely upon funding themselves that in turn is secured by the portfolio. So then you've got this problem where those facilities have eligibility criteria, haircuts, and we hear lots of, when we're out there talking to firms, that marrying up the what's in the portfolio with their loan covenants and loan criteria is a real challenge, and that's a highly manual process. So you layer on top of that an environment where credits are deteriorating, so maybe asset prices are going lower, haircuts may be getting bigger, eligibility criteria being breached. So I think that there's an increasing recognition that more automation is needed in order to enable the portfolio managers to really get to the decision points quicker, rather than just spending days or weeks compiling the data.
And so broadly, to what extent do you think that the technology is the answer? To what extent is the technology ready and available to answer something like this? Stas?
Well, technology by itself is rarely the answer, but technology can enable the right answer. Because, it all comes back to basics. When you're looking at the 5 C's of credit, in the case that we're discussing now, the conditions have changed considerably, and we don't know what the interaction is between the terms on the loans that were issued and the current market conditions. Because, again, history does not repeat itself, but it rhymes, and we have a turn of the credit cycle, which we haven't seen in quite some time, and we're going to see different conditions, and that is going to test the quality of our data, because ultimately, if we have garbage in, garbage out, so no amount of early warning technology is going to help us in that situation. So it's being able to assess what makes sense, what assumptions make sense, what conditions in our loans make sense, and the ones that potentially will be stressed, and then create an automation and a framework of monitoring that directs resources to the areas where we have the least certainty about it. Because otherwise, technology has gotten really good, so we have a lot of information that can be generated very quickly, and being able to absorb all that is going to be quite challenging. So it still requires a human, and still requires understanding what concentrations are and how credit is issued.
Jay, your perspective on the same?
I think I'm with Stas on saying technology is an enabler, it's not the answer, because technology does what we ask it to do. I think I'll go back to the fundamental question in terms of non-banks, and it comes back to Feroz's original point on, when you have non-traditional lending, the solutions have to be non-traditional. Because it can be a sectoral analysis, deteriorating asset quality, availability of credit decreasing. So it needs a non-traditional approach to this whole thing, which essentially means deep domain analysis of a particular sector, or it could be looking at non-traditional sources of data to make decisions on credit. So erstwhile it was core banking, it was loan origination. It would tell you a check is going to bounce, or something is going to happen which indicates stress in the system. But that's all a lagging indicator. It's more focusing on what are the lead indicators to enable that fact that you will be having stress, and therefore you need to act. So one is the question of where you get the data from, which is more about monitoring things that we normally didn't do. Commodity prices in relation to credit. Looking at, is there a diversion of funds because of stress in the system? These are non-traditional methods that you would use to look at, is there going to be stress in the system because of macroeconomic factors, and how technology would roll up and would kind of get you that data that enables you to make the decision. Second is also about the timeliness of the intervention. It's just not about saying that, oh, this has happened, so now how do I clean up the mess? It's more about saying real time, can you have that decision in your hand, which actually tells you do not lend or ask for more covenants or look at collateral management in a different form and kind of do those interventions in a timely fashion. And there cannot be a greater tool than technology to enable that, because this is where you translate a lot of the new technologies such as AI translates what you would call a gut feel into a science. And we need more of the gut feel translated to science, and that's when you would have technology would have its proper place.
Right. So you really think about technology as expanding the universe of methods that you can apply and the range of signals that you can generate, and of course the speed of signals that you can generate. Feroz, from your perspective, Feroz and Tony, both of you from an operational perspective, how do you see that?
Okay, so I'll give you an example of what happened when neobanks came and they started selling products and services. I was in one of a big box stores in Canada, and during one of the festival season, and I could actually get a credit card from a neobank for my 18-year-old daughter in minutes, while she had no credit history. And her traditional bank had given her a small limit, while this credit limit that I got in the store was 8 times greater than the limit that the traditional bank had given her based on what was in her current account and all that. So if that's the underwriting standard that's going to continue, and the data that was collected was minimal. So if we go back to Jaya's comment that, okay, when we have a problem, we need to analyze the data. Do we have those data elements? Did these neobanks actually collect the data elements for those borrowers or for the potential customers? They would have taken more products from them subsequently. And today, when the credit environment is tight, do we have the right tools and the right data that we can actually go and even recover the money or even have a contact with the customer? Because these are non-traditional, no brick and mortar institution. My daughter does not know who is this bank because she just has a credit card with a logo on it. So I think underwriting standards important. And then coming to the point which was made by Carl was basically that ultimately these neobanks have taken credit against that securitization, right? They have securitized their credit portfolios or the loan portfolios. There are covenants on that. There is tight credit condition today. And ultimately, the lenders are from the organized sector. It's like traditional banks or private equities or other financial institutions, non-banking financial institutions who have funded these neobanks. And now they will default on those credits, which will bring in a contagion to the economy. So everyone is in the same boat. Neobanks started the spiral. The traditional banks will get involved. Private equity will get involved. And then we will have the same thing that we saw in the subprime crisis in the US. So I think the data issue is very important.
Jay, your perspective, you have
I think from a perspective on a lighter note, they do know that neobanks collect alternative sources of data. One of that is the social footprint, and the social footprint would clearly say Feroz is sponsoring his daughter and therefore the credit is good to be paid. So I think it's more about what sources of data are you tapping, how many degrees to which the connected network and what is there. So there are alternative points of social data that's also being collected in making that decision.
Yeah.
So
Stas?
But also the challenge with that is some of that data, while it is a wonderful new source of information, has been untested through the cycle. And so monitoring how good of a signal that you get from this data is incredibly important. And going back to actually the technology topic, this is where I think technology can help greatly, is be able to identify where the assumptions in your model, which based on a certain set of, environment and relationships where they still hold or don't hold, an ability to detect that before everyone else does and take an action based on that. Because also there's a flip side to being too conservative as well, because you do have a relationship with a customer. And if you start cutting lines, or if you start taking risk mitigation actions where they were not warranted, you break that relationship. So this has to be approached carefully as well.
No, that is clear. But just on that breaking relationships, obviously there's a challenge in the retail market and so on. But those things become even more important in things like wholesale, and particularly when you have corporates whose bonds you've underwritten or you've provided loans for. One of the interesting things we see at this point is there is still continuing expansion in the private credit market, despite all the worries that we have heard in the room and outside the room as well. What do you think about that? Do you think the market is has the right data, has the right risks priced in, the right systems? Stas?
Well, let me jump in here. I think that by and large, the amount of data is there. Whether it's the right data or not, we're going to discover as conditions change. I think ultimately, no model is going to be exactly right. So having multiple perspectives is going to be important. It's about gathering number of signals, understanding the weight that each one of the signals makes, and then ultimately guiding a path forward. Because conditions are different now. Providers of credit are different than they were during the global financial crisis. So we're not going to have the same type of environment. The liquidity is going to be different, and I think that the providers of liquidity now are a lot more. They're not interested in being in providers of liquidity through the credit cycle, because that's not their primary business. So you're going to have, I think, a lot more, quicker evolutions of the shocks, and hence ability to detect those and kind of make those decisions quickly based on a set of rules versus feelings. I think is going to be key in navigating that.
I think that's a very interesting point that you. Sorry, please, Tony.
Yeah, going back to your question, it's usually we have to differentiate between the types of exposures that bank take. So yes, for retail banking, like Feroz was mentioning, the underwriting standards are straightforward, not that complicated, because usually exposures are low for small amounts and spread over a large number of borrowers. Data in this regard can help a lot, because lending to individuals is much easier than lending to large corporate or to SMEs. But again, within the retail arena portfolio, historically, for example, credit cards, we didn't have large losses. Banks didn't have large losses in credit cards portfolio. Large losses came from mortgage loan, housing, because these were large loans. But still, underwriting standards are easy, and the data can help a lot, because you have a lot of data coming from individual borrowers. If you move up a little bit to SMEs, things become more complicated. If you go up to large corporate, then yes, data can help, but not as much as one might think. Because large corporates, they have policies, they have procedures, they have vision, they have business models. The data for corporates is more relevant when it comes to macroeconomic data, industry data. Yes, so type of data varies between the type of exposure you are taking, and for the monitoring, it helps for the underwriting, but also for monitoring. Again, it is the same. You have to differentiate between what you need for each type of borrower. So I think what we are seeing today is more data related to individuals and not to companies.
So just to add to that comment, I think if you look at the loss analysis, it comes from large corporates, and it comes from the willingness angle rather than the ability angle. So more frauds in those portfolios is what you see, which drains most of the losses happen. This is where you would find that data that goes macro helps a lot, and there is, when it comes to stress, it's more the micro. So I think it's important to kind of look at it in terms of a Pareto analysis and say 80% of my losses come from this particular angle, and what do I do to prevent it in terms of the macro issues. Obviously, if it's a neobank that specializes in a particular sector and the entire sector credit quality is really poor, then that's a different equation. So we kind of separate that from large banks, large corporates, and also in terms of the segment in which you operate. And data availability is plenty. It's about, are you looking at the right things? It's more about, again, regulation is, if you look at it from a regulatory lens, it varies by country as to what you can look at, what is the kind of data availability. If you look at Middle East, since we have representation from the Middle East, that is something where a lot of the social data is not something that you can use, or the availability of other alternative sources of data is not plenty. Whereas in certain other countries, from a privacy perspective, there are only certain types of data you can use. So when you filter it through all of the lens, what you get is a assortment of data that is driven entirely by the profile of the sector you operate with, the country you operate with, and the types of quantum of data that you're looking at.
Absolutely, that's an interesting point you make, and particularly if you think about some of the early warning issues in Asia, etc. Many of the Asian banks have been somewhat, Asian central banks have been more advanced in the whole credit monitoring issue, partly because they see a lot more challenges in their credit environment, if you will.
Yeah.
So Jaya, would you talk a little bit about some of the issues that have happened in India, for instance, and some of the other Asian regions around EWS, if you will?
Yeah, so the biggest problem a few years ago in the Indian system was non-performing assets. They were at double digits, which means the quantum of losses when you look at the book value is staggering. It's incomprehensible when you look at it from some of the smaller countries' perspective. It's like trillions of dollars that's at stake, and that comes from your book being double digits of non-performing assets. So there were a lot of thoughts going into, do we go into bad banks, how do we kind of reduce that? An early warning system was kind of made mandatory to kind of look at it for especially PCA banks, which are banks that are operating under specific stress issues, which were most of the public sector banks at that time. And the central bank, which is RBI, came up with saying you must have an EWS system in place. And it was also driven by clear logic of these are the minimum 42 alerts you need to look. That expanded to now hundreds of alerts that you need to monitor, which comes from kind of growing up that radar and saying that if you don't have these parameters, then you're not going to get more funding from the government or any kind of handouts to kind of stay in place. So that was very landmark development from a central bank that said you must have this in place. What that meant, the traditional sources of data would give you only about 25 to 26% of data that's needed as an alert. External, all of the unstructured sources of data and alternative sources of data would provide the balance. So it was more about, I know generational AI is used a lot in conversations at the drop of a hat these days, but the traditional AI was more about looking at how can the past predict the future. And that is in very simpleton terms if you look at it. And there was a lot of usage of that from a central bank perspective and saying this is what we focus more on the willingness to pay, which was the cost of loan scams, which was what happened with Kingfisher, what happened with the Nirav Modi case and all of that, which was kind of like a wipeout of the banking books, which was kind of like staggering billions of dollars that went in. So I think that was a great response from the central bank, and that was something that became almost like a landmark movement in terms of central banks around the world to say we need to have a credit monitoring system not only at the bank level but something at the central level that actually we monitor the banks that in turn monitor something.
That's right.
So I think that was a masterstroke.
a systemic AWS, if you will.
Yeah.
Feroz, you wanted to comment.
Yeah, so if you're talking about, large corporates, essentially, we do not want our borrowers to go into default. So we start workout much earlier than it goes into default. If it goes into default, even a 90-day default triggers so many issues. You have non-performing ratio, you have impact on the LCR and SFR, then you have the impact on the capital charge that would come in. And it has got a spiraling effect on your bank's performance. So you don't want. And for that reason, for the large corporate, at least where I operate, we have the relationship manager model. That's the relationship manager who needs to be in touch. It cannot happen in a large country like India for everyone, because you have a big middle market segment where you don't have a relationship management model. But for large corporates, you need to have that. You need to have the banker being very close to the borrower. Also needs to have information from other sources like peer banks, what the peer banks are doing, how is his relationship with the supplier and his the customer and all that. All these data needs to be populated. What we used to do earlier when I was in Citibank, we used to have something which we used to call the BIR, Basic Information Report, that would list out everything about the customer. Who are his competitors? Who are his suppliers? Who are his customers ultimately? What is his credit terms? All those information is available, and we used to actually track that. That was our simplest early warning system that we used to have even before actually onboarding the customer. After the customer is already your customer, then you need to have other early warning systems that Jaya was talking about, that you have 20 or 50 parameters that you can look at. But in some markets, that does not work. Like in the Middle East, even a single check bounce is a criminal offense. So that cannot trigger early warning system. I cannot rely on a check bounce as one of the early warning systems. So I need to have something different. Yeah. So different, as you mentioned, different geographies, different regulatory environments require different data elements that needs to be there. And for large corporates, I would go back to the basics. You have to be close to the customer. The other analogy that I want to give is, I mentioned that earlier, is early warning system. You want to be the first bank to protect your credit, but you also don't want to be the bank who actually triggers the issue for the customer getting into default when he was not really going to default. So there's a delicate balance that we need to maintain there. Thank you.
Very quickly, Jaya, before...
Very quickly, I think that particular model of RMs did exist in India too, and that was part of the problem. Because, the scams didn't happen because he was really, went from a really great customer to a bad customer overnight. They were continuing to lend. And it was more about, we will lend more to solve the problem. And that's when the gut feeling of saying it is a relationship in this particular part of the market to signs where somebody is monitoring you and saying, why are you lending more when the covenants don't point out to it? So when there is something that's more of an override, when that's something of a system issue, which is being monitored by a central bank, it's being monitored at multiple levels beyond the branch at a central level, there is more onus to it, because these star customers were star customers. And it became the star customers' problem and not the bank's problem. But it was the banks that continued to lend when they knew that a lot of the covenants were off. So I think it's different strokes for different folks, and it's also different solutions for different markets. But fundamentally, it is more about taking that gut feel, taking that relationship in its effect, and converting that to more of a broader science. I think that worked in this market.
Right. I mean, so I think
it all goes back to know your customer.
We have two distinct views here. We have one view where people are the most important, and a related one, which is you still need a star chamber and a technology to monitor them for that. But Tony, any maybe the third perspective on this?
Yeah, exactly. As Feroz correctly mentioned, what we need, because for large corporate, it's on a case-by-case basis. The need is to be able to come up with a system where the covenants and the indicators that you want to monitor for each and every corporate client, and these are different from one client to the other, how to automate these. This is the main issue. Because if you don't automate, what will happen is that in some cases, the RM or the relationship manager maybe will forget to check this item or that indicator. Or in case it is checked, it is not properly escalated. So if I think that my client is selling to country A, is exporting to country A, who is monitoring the performance of the buyers in the country A? What will happen if the buyer in country A would stop buying my client's product? So you need to automate this. So it is done every month, every 2 weeks, I don't know, every 3 months. And then it is properly escalated to take decision quickly.
Carl,
And I would say probably daily, because some of the information, so you have market information about your borrowers that potentially daily traded assets, market provides information. Then you have macroeconomic information, the conditions part of it. And then you have the financials, the balance sheet, the income statement, the various filings. And so the key is to be able to take this disparate source of information and combine them into a signal, ideally daily, that will provide you information about not just about the risk, but the time horizon of risk. Because let's say if someone has a big refinancing coming up 2 years from now, and they will be probably in trouble repaying it because they're not going to have cash on hand. If you're lending them for 1 year, that doesn't really matter. But if your loan is 3 years out, then you probably should be thinking about proactively reaching out or somehow working on reducing that exposure. So the frequency and the time horizon, I think, matter a lot here as well.
I think some
and also the type of indicator you choose, because there are some indicators which are classic and easily identifiable. But for example, if we take what happened in the COVID-19 period, some strong companies disappeared from the market just because they did not cope with the new trend, with the new way of business. So sometimes it's difficult to identify the right indicator. Also, this is a challenge.
Of course, events can always lay waste to the best laid plans of men and mice. But Carl, you had a point.
Yeah, I was just listening to this fascinating conversation and also translating that into the energy commodity markets, where I don't know the data and the operational problems go into a different world, because if you are a producer or you are a trader of a commodity or an energy product, you often you have a limited choice about who is buying your product, so therefore who you're going to give credit to. And yet most of these big companies, they have rigorous credit processes. So a lot of that then translates into risk mitigation. So you have tracking of shipments. What ship is it on? Where is it in the world? Which delivery point is it going to? LC allocations, credit insurance policy, discounting programs. So all of this layers on top of the normal credit process, a whole load of operational things to do with the physical commodity. And then you've also got then that risk transference. So somebody is writing that credit insurance. Somebody is providing the LC and the discounting facility on a non-recourse basis. So then the quality of that portfolio can also have a contagion effect if something goes wrong. And then you've got the political risk. So a lot of our clients are starting to think more about what they call performance risk, i.e., I don't have a direct credit risk in one sense, but I have a risk that the commodity I thought that was being delivered to me in this part of the world, or I was delivering in a certain part of the world, can no longer be delivered there because of geopolitical problems. Now I have to take delivery or make delivery somewhere else, and that incurs substantial costs sometimes. So that mixture of sort of the pure credit plus the operational and the physical aspects of that make it quite of the last 18 months, you've seen, the energy markets in Europe have changed dramatically. So long gone are the days when you would have a single gas contract with a certain company for your supply of gas into Germany, France, or wherever. Now there's a lot more trading, so many more counterparties, many more trading venues, migration from exchanges to OTC because of the lack of control around margins that you've got when you're trading on an exchange. So all of that has meant that both the credit risk, the velocity, the operational risks, the geopolitical risks in that particular part of the market, talking about horses for courses, has just gone through the roof. So there, I think, back to one of the earlier points of this conversation, technology doesn't solve that, but technology helps you to manage all that collection of problems in a way that enables you to get to the decision making a bit quicker.
No, absolutely. I think energy markets are in some ways an advanced lesson to other sectors to think about operational aspects and their impact on credit, and vice versa, the intersection of operations, markets, and the credit issues in other supply chains.
And it's not just pure credit risk, there's confiscation of assets, there's inability to deliver, there's, you might be willing to perform on a contract, but actually you can't. So actually political risk, geopolitical risk, that kind of thing, inconvertibility types of risks are really, running amok in those markets, or have been over the last 18 months. It's interesting.
These risks usually can be mitigated, the first mitigant of credit risk is legal contracts, perfected legal contracts. So, even if you're the best risk manager in the world, you have the best criteria, best models, and if this is not reflected perfectly in your legal contracts and agreements, then you're at a high risk. So we try to mitigate as much as possible using good agreements, perfected agreements. We try to manage our operations as perfect as possible, because as you have mentioned, legal risk, liquidity, and operational risk are interrelated. Interest rate risk, same thing.
Feroz?
Yeah, so you mentioned about events that could actually trigger certain issues, and then Carl mentioned about the energy sector. I would like to bring in aviation sector. We had a lot of exposure to aviation before pandemic, and then there was this issue of 737 MAX going out of circulation. We had a lot of leasing companies who had booked this aircraft with Boeing, and then they had paid down payments, they had committed, and there was no deliveries going to happen. So what happens? Do we get a refund from Boeing? Are they going to refund the down payments, or are they going to give deliveries of some other aircraft over the next 5 to 10 years? And we have financing against them. So each industry segment, and for the banks which specialize in those sectors of the economy, it becomes a risk that was not anticipated, and these are 1 in 25-year risk. You never expected that a pandemic could affect the aviation sector and there would be a lull in demand. And today, 3 years down the road, there is no seats available. We are paying through the nose for a seat on certain sectors of aviation. So it all boils down to how do we anticipate the markets and what controls that we can put in place.
Stas?
It's interesting. We started discussing credit risk, and then discussion evolved into the interconnection between the risks, because what we've seen here in the United States is, inflation risk triggers interest rate risk, triggers liquidity risk, triggers credit risk. Yep. So now you have a much closer interconnection between these risks, and ultimately it calls for a paradigm of thinking about risks in their totality. So integrated risk management, of understanding that if someone is in default and they're not getting payments to you, then you have potential liquidity problem. You have different interest rate sensitivity profile, and ability to have decisions made on your credit portfolio in context of liquidity, in context of interest rate risk, and also in context of your own credit risk, to say, okay, if I do this, does it make my firm riskier or less risky? Because then you also have exposures as well. So I think it all comes together. And I think this is really going back to the topic of technology, where technology can help, is bring all this risk quantification, the level playing field to give decision makers a dashboard, a view of how to actually navigate and how to make informed decisions.
Yeah.
Yeah. Stas, today we have a lot of models and softwares where you can manage your operational risk, but separately from your interest rate risk. And again, for credit risk management, we have different applications, different modules. Initiation is separate from rating. Rating is sometimes separate from financial analysis. Collection is different. We have elements. What we need is to have a solid model where you combine all these and where you have enough level of detail depending on your type of exposures.
Of course, full integration is an holy grail. But before that, Jaya, very quickly.
Yeah, I think it was more going back to Feroz's example. I think it was earlier as risks practitioners, the focus was on high impact, high probability items. The pandemic changed that on its tail because the pivot was very different. It was more about low probability but high impact. That's actually a lot more important because the aviation industry was one example of a pandemic kind of coming in, and then the geopolitical angle to it. So what are you really focused on what you're modeling for, which was a completely different shift in thinking in terms of these outlier events and what will be the ramification of that for the longer term. And that continues to kind of pay with a lot of the incidents that are happening. And I think it's a pivot in terms of risk management as such. One is the complete integration, the holy grail, but it's also what are you looking at really? And how do you kind of protect yourself against that? Legal is one angle of it, contract risk is another angle of it, but then you have a lot of ramifications around that, and the energy transition, that's a core important fact of that as well.
No, of course, we're seeing, as you rightly pointed out, there are challenges from the contract structure, there are challenges within the legal documentation, and there's obviously an integration issue that has been pointed out. But Feroz, you have a few perspectives there, if you will.
Yeah, so actually coming to integrated view of the risk, yes, we will continue to have these peripheral systems that we use for different types of risk. But ultimately, what is now being expected by the regulators is a holistic stress testing framework, which is actually bringing everything in one place, because the regulator wants to see what would be the impact on the balance sheet of a bank if certain risk appeared at the same time. And they want us to actually stress it concurrently. So we are stressing credit, we are stressing our investment portfolio, and we are also assuming worst case scenarios for our operational risk. And we have to put in those things into our stress testing framework and then submit the results every quarter essentially to the central banks. And that's where the data comes in. So what you actually collect and what you put it into these models is what is going to throw out the numbers that will show inadequacy of capital or the inadequacy of the profitability in the future and all those things. So again, coming back to our original discussion, is data is very paramount, even if we want to do an integrated view of the risk.
Great. So,
and the next step is go beyond 3 scenarios, go beyond baseline adverse and severely adverse, and actually consider a span of possibilities that can be more realistic in terms of the factor correlation breakdowns and really the outcomes that go outside of a traditional credit shock. Unemployment goes up and GDP goes down. I think that's what the events of the last couple of years have shown, that the funnel of uncertainty is a lot wider than what we believe it to be.
I like that term of
3 scenarios for multiple years. So you have permutations and combinations that you need to do.
Yeah, and I like that point about funnel of uncertainty being wider. So with that, so funnel of uncertainty, to repeat Stas's point, is wider. We have a lot more data. We counted at some point more than 4,000 sources of alternative data, if you will.
Yep.
And we've seen some of the challenges and trade-offs, or not trade-offs, rather. You need to have people, you need to have systems, you need to have systems at the right point, you need to monitor your collateral structures, and we saw in a couple of industry-specific discussions. I'm going to now, we're coming to the end, and we're going to close with the final, very short and snappy discussion on the frontiers of credit risk management, or some of the boundary issues in terms of things like climate risk and ESG being integrated into credit risk calculations, methodology, and data collection. With that, I'll have everyone take one quick shot at it. Jaya?
So I'm most intrigued by climate risk and the impact on credit risk, because that is something that it's very industry specific. Because when you look at banking and financial institutions as a whole, it's more about I have to look at my own ESG requirements. I have to look at my credit of, what is the credit that I give to my portfolio. I also have to look at a lot of third party kind of risk and what that poses and how that matters to me. So you said briefly, so I'm going to stop with that.
Yeah, I would agree. Climate risk is one of those frontier things, one of those frontier issues being addressed by credit functions. And the central banks are putting much more pressure now for them to incorporate climate risk factors into their credit assessment. And yet I think even the tier one global banks are being very cautious. So they've always, they've had programs ongoing to start to collect the data and to start to test out these models, but you get a sense for fear of the unintended consequences. So what you don't want to be doing is suddenly pulling away liquidity from major parts of the economy. You don't want those perhaps dirty industries to end up not being run and owned by legitimate well-run legitimate companies and going off to less well-run, sort of less ethically minded companies. So there's a lot of I see a lot of testing of these models in a kind of a POC type of way, but yet to make it into mainstream. And I think that's the next. I think that's going to be a theme for the next 1, 3, 5 years. How do you make that mainstream?
Tony?
Yeah, in addition to climate risk, definitely, I think major concern is the new way of doing business everywhere in the world. Technology advancement has changed a lot of things, especially locally. In each country, you have new businesses coming up, old businesses disappearing. At the international level, I think the political risk, geopolitical risk is very big nowadays. It has been the case 2 years ago, since 2 years, and I think it's going to remain the case. So for the players, for the international players, it's a big change. So if you're lending internationally, God be with you.
Interesting perspective. Stas?
Yeah, the geopolitical risk is a big unknown. It's hard to predict. The government actions are going to be difficult as well. Actions of borrowers as well. I mean, we see behavior changes. Some of it is driven by technological change. Some of it is driven by the demographics that we're experiencing. And then climate risk. Climate risk is a stress test for stress testing. We're looking at exercises that go out, potentially 100 of years. And then you have new data sources, you need to adapt your models, you have limited amount of data vis-a-vis what you're trying to forecast. So it is going to be a very challenging and data-intensive exercise, which also will be full of very big assumptions that need to be made and ultimately monitored, and it will have a big impact on our lives in the future. So I look forward to seeing how it all unfolds. It's definitely going to be exciting times.
Feroz, perhaps the last one.
Yeah, so geopolitical and macroeconomic risk. These are some things that will impact everyone, but in a different way. So where you're operating, where you have exposures, it would have a different impact from geopolitical and the macroeconomic factors. Coming to climate risk, I've seen from multiple central banks the requirement of climate risk to be incorporated in your credit risk, in your operational risk, and also in capital planning. So they specifically tell you in the capital planning, you need to put climate risk factors and you need to set aside a capital and also have taken through the operational risk and all that. But how do we use this data how would we use this data for credit risk basically is going to be a challenge. you don't want to actually impact all your borrowers. As Carl mentioned, you can't actually stop credit to a certain sector because it's not meeting the climate risk requirements today, but that's your bread and butter. So I think pricing mechanism is something that we can look at. Borrowers who meet the climate risk challenges should get a special pricing. Those who are not meeting could pay a higher price for the credit. And that differentiation between the borrowers will happen for the next few years until we have more data and more transparency in terms of what these models on climate risk will actually throw out. Today, the challenge is how do you bring climate risk related issue into your risk rating model? Do we really need to have climate risk incorporated in the rating model or outside the rating model? So it's all going to have repercussions on our performance as well as ultimately the external rating of the bank. So that's where I want to end it. Thank you.
Well, thank you. Thank you, Jaya. Thank you, Carl, Stas, Tony, and Feroz. I think we've done a rather whirlwind tour through the key challenges today and the challenges that are going to be there tomorrow and the day after tomorrow. Thank you all for watching, and see you again soon.